The Bitcoin blockchain is the most powerful computing network in the world. It's 1,500 times more powerful than the CERN supercomputer.
You always said that we want to replace trust with truth.
The banking industry has had a good 838-year run, extracting about 6 to 8% of global GDP every year in fees for trust.
We all need it. We all use it. There's great examples where it saves our bacon, but is it worth that much? Probably not.
Here's the thing. We didn't have an alternative before. Now we have blockchains which disrupt financial services. The trust industry revenue will fall.
Did the CIA invent Bitcoin to steal all our money?
It's not out of the realm of possibility, but now it doesn't matter. It's now grown to this trillion asset that's owned by 200 million people around the world and has become its own thing. This is going to be the base layer of money for the next 5,000 years.
Mark, just any final thoughts?
First and foremost, you should go back and watch all of your old episodes. I mean, you are a great educator, a great interviewer. You have the best guests. Once you do the work, once you have that light bulb moment, you can't unsee it. Get involved in the communities. Get to know some of the people. Make investments. Because if you don't own it, you won't watch it. Our whole culture is all about not failing, not taking risks. Baloney. Take intelligent risks. Don't be afraid to fail. Learn from it. Keep going. That's my mantra.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Mark Yusco, the Bitcoin evangelist, hedge fund manager, and philanthropist. You are the founder and chief investment officer of Morgan Creek Capital Management, an investment firm that manages almost $2 billion in assets. You have over 3 decades of experience in institutional investing, following the endowment model as a core philosophy. You have said that the greatest wealth is created by being an early investor in innovation. And you are regularly featured on networks like Bloomberg, the New York Times, and the Wall Street Journal. You have said that everyone should own a percentage, big or small, of Bitcoin as a hedge against the continued destruction of fiat currency. And you believe that during this cycle, Bitcoin's price could hit $150,000 as a result of institutional investment, FOMO, and the recent Bitcoin halving. Mark, welcome back to London Real.
Oh, such a pleasure to be with you. And I appreciate the kind intro and excited about the conversation as always.
Can't wait. I love how you have no holds barred. And, I love the fact that you bring all this institutional experience to this blockchain space. And I always consider like the trifecta, you and Tapiero and Moorhead, as my kind of go-to old school guys in a new school asset class. And I'll be honest, Mark, when I travel the world, I find that the younger generation, the kids in their 20s and 30s that are into this space, they love to get the insight of guys with some gray hair, like you and us, and they really listen carefully. And that's why I love sitting now and having conversations with you. Your episode is one of our most popular ever, so I can't wait to jump in, and I'm gonna jump in. We've just had the halving about a month ago, and I know you have some distinct opinions on the halving. The memes out there are that it came and went and nothing happened and everyone's waiting around. Now, of course, in the blockchain, unlike traditional finance, if it doesn't happen in 2 or 3 days, it's too long. And of course, if you don't make 10% a week, it's not a good week, right? And so Obviously the expectations are high, but what is your view on what happened at the halving or what's going to happen on the back of it?
Yeah, it's an important question. And it was a little bit different this time, right? And those are the four most dangerous words in investing. It's different this time.
Right.
And you never like to say that it is. One of the things about being an OMG, right? Self-proclaimed old macro guy. So with Tapiero and Moorhead and people like yourself, we are, old just means you've been through multiple cycles and you get to learn from those cycles. And, I was lucky, and it really was luck that, Dan Moorhead called me up back in 2013 and said, hey, I'm shutting down my hedge fund that we had helped him start 20 plus years ago. And helped him in the sense we provided financing and he did all the work. But he said he's going to spend the rest of his career in Bitcoin and blockchain. And look, in 2013, I joke, I wasn't running drugs on Silk Road. I was not a cryptography student. I didn't get it. But the moment I did any work and I understand that blockchain technology was just an evolution of compute, it became real. And I spent, the rest of the last decade really going deep down the rabbit hole. And when I think about this cycle and why it was a little bit different, we had a demand shock. And that demand shock kind of overwhelmed one of the things that normally happens in a halving. Well, what do I mean by that? Well, what the halving is, for those who don't follow, is there are block rewards. Every 10 minutes, a certain number of Bitcoin are given to the operators of the validator nodes that secure the network. And so if you basically create a data center, you buy a bunch of machines, you plug them in, and you tilt them toward the algorithm, and you try to secure the network by cryptographically securing the chain, and then you get rewarded. So if you think about it, it's a pay-as-you-go system. People are contributing computing power to this network, right? The little b Bitcoin blockchain is the most powerful computing network in the world. And this is a crazy stat. It's 1,500 times more powerful, not 1,500%, 1,500 times more powerful than the CERN supercomputer. So it's a really powerful computing network. Wow. It's never been hacked, right? It's been up for 15 and a half years. It's had downtime of like 20 minutes. Not one hack, not one fraudulent transaction, not one error. It's a very, very powerful machine. Why? Because it's monsters. Well, why is it monsters? Because these block rewards are very valuable. Well, if you think about it, I buy my machines. They have a price. I plug them in. My electricity has a price. If suddenly every 4 years, those block rewards get cut in half. So on the first epoch, you got 50 Bitcoin, 50, every 10 minutes to be split up amongst the miners. Amazing. Then it went to 25, then 12 and a half, then 6.25, now 3.125. So we just went from 6.25 to 3.125 every 10 minutes. So wait a minute. If my costs are fixed and my revenues just got cut in half, theoretically, half of those miners would go out of business. But they didn't. In fact, we have higher hash rate today than any time in history. So the number of miners keeps going up. Well, how does that happen? To me, Brian, it's one of the most ingenious things about Bitcoin was the hard coding of this event that would cut the supply. That's genius because it makes it the hardest money in the world. But it also creates an impetus or a catalyst, back to my chemistry days, to have price go up. Well, what do you mean? Well, if you think about it, if the price stayed where it was and the block rewards get cut in half the miners go out of business. Well, that can't happen because we need the hash rate to keep growing. So what happens is the price adjusts, and this is the genius part. When things move, people get interested. To your point, if the price isn't moving, the average person doesn't want to pay attention. And so, price of land. Land is boring. I mean, come on, it's just boring. It doesn't move or it doesn't get marked to market every day. Real estate, buildings, okay? Stock prices, a little more volatility. Things that have volatility, people care about. And so if the price now suddenly moves, more people are drawn to it. If more people are drawn to it, demand goes up, supply is fixed, price is going to rise. And so what has happened is we've had this 4-year cycle where the price moves. That movement post-halving creates FOMO, and people really start coming in. Then we get overvalued, and then the shorts come in, and we have a bear market, and then we start over. So why is this time different? Well, before the halving, we were on the way to fair value. So if you go back one cycle, the fair value was 32,000. What is fair value? Fair value is determined by a Metcalfe's law model. There's a guy, Tim Peterson, who keeps it, and he has a really good model. Well, the price got to 69. Well, 69 is too high. So what happened? We had a bear market. But in a bear market, you don't just go down to fair value. You go through fair value because people are freaked out. They get liquidated because they're on margin. And so we go down in the bear market. Well, when the price gets below fair value, what happens? Investors who like to buy things below fair value start buying. And that's crypto spring. The price stops going down and starts to go back up. Well, then what happens? Then the traders come in and the traders start to push the price because there's more activity. And we start to go back towards fair value, and that's crypto summer. Well, crypto fall, which starts here in June, is when the real momentum traders come in and the speculators and the gamblers. And then you get the big parabolic move. That's post-halving. Well, why? Well, again, normally when the block rewards get cut in half, the price needs to rise and that draws more people into it. Okay, well, this time in January, we had the approval of the ETFs. Well, the price was about 40,000. Fair value had moved up to 50,000. And we were going just like normal. We'd hit fair value at the halving, and then we'd go into the FOMO. All right, well, this time we went from 40,000 all the way up to 70,000. New all-time high. Well, why was that? Supply and demand. There was new demand, limited supply. And the real problem is the actual supply of trading Bitcoin is very different than the hodled Bitcoin. You know, there's the Bitcoin that's been lost or stolen. That's never coming back. There's the Bitcoin that isn't going to move because people just don't want to sell it. So about 30% of the network tokens trade hands on any given year. And so there were about 900 a day being mined, and the new ETFs were sucking up about 6,000 a day. So if you got demand for 6,000, supply of 900, price is going to go up. Okay, so we got above fair value before the halving. Why does that matter? Well, on the halving, if the fair value was 50, then we're going to go to 100, right? Because we got cut the rewards in half. You double the fair value. There was another difference. This time, because of ordinals and runes, right? These protocols that are built on top of Bitcoin to allow inscriptions. Think about it. If you own a digital asset, a digital artifact, a piece of digital property, where do you want to store it? Do you want to store it on a network where the actual asset isn't on chain? It's actually on an AWS server somewhere and there's a pointer? That doesn't seem so secure. Like, what if AWS says, all right, you can't get your asset? I'd rather have it on chain where I control the keys. So ordinals allow people to inscribe digital assets onto the Bitcoin blockchain. Well, in order to do that, they have to pay transaction fees to the miners to secure the network. So now transaction fees start to rise. So maybe fair value this time doesn't have to go up quite as much. So let's say maybe it goes to 80,000 this time instead of 100. Okay, so between the halving and sometime, when crypto fall starts in June, we should start to see things creep toward that new fair value of 80,000. But Mark, we got all this volatility. What's happening? The third thing that happened that's different is the paper market for Bitcoin got very, very large. And This happens in commodities. Again, you've been doing this a long time. You've seen lots of examples of the gold market in London for years has been spoofed, right? You see all this money printing around the world, but gold prices didn't seem to move. Why? People like JP Morgan, and I can use their name because they got fined $1 billion 3 years ago. Think about that. They got fined $1 billion for spoofing gold. Well, what does that mean? It means they sell paper gold in the market to push the price down, and then they can be long actual gold or gold ETFs, and they can arbitrage profit. And they made $20 billion doing this. Now, you're not supposed to do it. You're not supposed to go naked short, so you get fined. And they're like, we made $1 billion. I mean, we made $20 billion. We paid $1 billion. That's the cost of doing business. We'll do that all day long. I would do that all day long. Now, I don't like to break rules because I'm a dutiful firstborn. So I'm not going to do it. And I don't have the capital base that JP Morgan has either. But now that's happening in Bitcoin. Very quietly, and nobody's talking about this, very quietly on the same day that the Bitcoin ETFs were approved, the CME approved a whole host of new derivative contracts on Bitcoin. And what it allows is for paper Bitcoin to be created. And everybody thought that the ETFs were going to be so great because it was going to increase demand for actual spot Bitcoin. Because a year earlier, when the futures ETFs were approved, all you were able to buy was the futures contract. There was no change in the demand for spot Bitcoin. And so the price didn't move because there was no demand for actual Bitcoin. Well, this is actually worse than that. Because now, with all of these futures contracts, the big players can push the price down because, let's think about this. Is going to be the big buyer of spot Bitcoin in the new ETF world. These big institutions like BlackRock, et cetera.
Right.
Well, if they want to buy a bunch of something, would they like to pay a high price or a low price? A low price. So, age-old thing, and again, this goes back to my time, it's being an old guy. Soros, Robertson, Steinhardt, if they wanted to buy a lot of something, they didn't go out and buy it. They actually sold it, or even went short it and told everybody they hated it. And just one famous, I love this story. So Dwight Anderson worked for Julian, and he did this big report on why they should buy copper. And he went in, and Julian said, okay, that sounds like a good rule. All right, go sell 50 million of copper. And Dwight's like, I know, no, my report says buy copper. He says, I know, but I want you to go sell 50 million short and tell everyone on the street that we hate copper. And then we'll buy $500 million worth of copper. So I think that's what's going on right now, is you got all these big guys shorting, and you see it just about every night in the way the futures move versus the spot price.
Okay.
That's a super long answer to your question, but I do think that between now and the end of the year, we get a steady move back toward that new fair value of 80. And post-Thanksgiving, that's when I think we go parabolic.
Okay. Wow, that's fascinating. So you're taking me back, Mark, because I used to trade Eurodollar futures on the CME all the way out to what they called the reds and the blacks. This was year 9 and 10 to hedge the interest rate swaps on the swap book at Bankers Trust. Meanwhile, Tapiero is doing business with our swaptions, proprietary desk and probably moving things around. So I remember that. I've had Chris Giancarlo in here who ran the CFTC and is very proud of the fact that he introduced a lot of those futures instruments on Bitcoin and Ethereum. But I didn't realize that those new futures contracts were issued, and I didn't realize the price action. But like you said, if BlackRock looks into their future, they're going to be buyers in the future as they convert this baby boomer money, which I want to talk to you about, to put a small percentage of their portfolio in Bitcoin ETF. They're sure as hell not going to short it, so they're going to buy it. So you're right. They're going to be net buyers over the next 10 years. So why not move the price down so they can buy it cheaper? That's kind of what you're saying.
I mean, it's so logical. Now, that's the normal business, positive part of this is if I'm going to have this long-term buy, I'd like to buy at a cheaper price. So in the short term, I'm going to try to push the price down so I can buy it. There's a sinister side. The sinister side is Leo Melamed, right, who runs the CME, said like 3 years, I think it was 3 years ago, said, we'll tame Bitcoin. That's a strong word, tame, right? And what did he mean by that? And why would he even say that? And look, I refer to this as the three phases of the 4-part quote from Mandela that I guess someone else said that Mandela borrowed, right? First they ignore you, then they laugh at you, then they fight you, then you win. Well, from 2009 to 15, that was the first they ignore you phase. Bunch of nerds and geeks pay their magic internet money. Who cares? Stupid. All right. Then in 2016 to 2021, then they laugh at you. Ugh, bunch of nerds and geeks. But then Melamed and others and Operation Choke Point and all these other things are like, whoa. Okay. 10 billion coming out of JP Morgan, going into Celsius and Voyager and BlockFi. That's cute, right? Fine. We're paying you 0. You can go over here and make 6%. No problem. 10 billion. 100 billion? Now we got a freaking problem. All right. Now it's not cute anymore. So now 2022 to today, and I think till 2027 is the then they fight you phase. And I think Melamed's point is, look, you may think you're in control of this asset because it's supposedly a spot market and trades 24/7, and that's better than being in the market where it's closed more hours than it's open. But I'm the CME, and once we issue futures contracts, we can do some stuff. And so I do believe that there is a systematic or systemic, whichever way you want to look at it, aversion to this new asset. And at the end of the day, the end of the quote is, and then you win. So we're going to win, right? This is going to be, I believe, the base layer of money for the next 5,000 years, the same way gold has been for the last 5,000. But the next few years are going to be a struggle because, and we can go back through all the history, but look, the banking industry has had a good 838-year run. 838 years of ultimate supremacy, extracting about 6 to 8% of global GDP every year. Today, about $7 trillion with a T dollars in fees for trust, right? You're sitting in London. I'm sitting in Chapel Hill. I want to send you money. Well, I have to have a bank account. You have to have a bank account. I send a wire. They charge a fee. Bank of International Settlements comes in, says they have to get a fee because it goes across international borders. The banks make a lot of money. But I can tap my phone and send you Bitcoin. No accounts, no wire transfer fees, no BIS fees. So they're looking at this going, hell to the no, right? That is not good for us. And it's not different than anything else. There are a lot of things in life where technology comes along and it's better for the common person, but it's not better for the incumbent or the government. And therefore, they're going to put up regulatory barriers and they're going to, try to stop. But I keep going back. I'm an optimistic guy. I say, name a technology that was amazing, that got a little bit of traction, and then they put it back in the bottle. You don't really find many examples. Now, they'll fight it and they'll try really hard. But at the end of the day, we all have a much better life today. And it doesn't mean every single person has exactly the same life, but we have a better life today than we did in the Dark Ages or, the Roman, the Roman Empire was good, but the post-Roman Empire when the Huns came in was not so good. So you know what I mean.
And when you go 838, what date is that for the banking? Because I've heard Medici's 1500s, but you're taking it further.
Well, the Medici's, so the Knights Templar, literally, right? The Knights Templar, the Illuminati.
In London, right?
In Portugal.
Right.
Invented this idea of fractional reserve banking in 11 something. And the Medici's borrowed it from them in the late 1100s, and from 1200 to like 1490s, the Medicis ran everything. It was basically Venice and Rome, and that the Medicis were in charge, and not Rome, Florence. So Venice and Florence, and so then in the 1490s, Portugal took over, and then Spanish took over, and then the Dutch took over, and then the French, and then the British, and then America. So there's been this movement, but it was literally these knights. It was amazing. They were living in castles all over Portugal, and they would go out on these quests. Not exactly nice guys necessarily. I mean, bad things were happening, but they would plunder, and they would come back with gold, and they would deposit the gold, and then they would go out on another quest, and some of them didn't come back, right? 1100s was a tough time to be alive, and some didn't come back. And so these knights said, well, we have all this gold. Why don't we lend it to these other knights and have them go do a quest, and then we'll charge interest. And so they literally invented the idea of banking. And the Medicis enhanced it by saying, all right, we'll use the gold at the main bank, but we'll also introduce double entry accounting, because back then there was only single entry accounting. And the problem with single entry accounting is I lend you money, and I write down in my ledger on my papyrus tablet, because I'm old, that Brian owes me $100. You come back a year later to pay me back, and I'm an unscrupulous guy. I've changed the 100 to 200. You have no recourse, right? There's only one ledger. And so the Medici said, no, Brian, you keep a ledger, Mark, you keep a ledger, and we, the benevolent Medicis, we will make sure that the ledgers match. But here's the problem. So in the course of the year, I go to the Medici and say, guys, I'm going to change my number to 200, and I'll give you half. Okay, that works for us. So Brian comes back to pay. Mine says 200. And you're like, hey, Medicis, it's only 100. And like, Brian, you must have written the number down wrong. We're sorry. And so what we need is someone to govern the governor, right? We need someone to monitor that the banks do it right. So we create all this system. And for the most part, the banks are pretty good, except for the money laundering and all the fines they've paid. Here's the crazy stat. Banks have paid more in fines for money laundering than the entire market cap of the Ethereum blockchain. It used to be more than the Bitcoin blockchain, but now Bitcoin's over $1 trillion. But they paid $500 billion of fines, right? That's not what they got away with or how much they laundered, but that's the fines. And that's a big number. And so there's this system that grew up around, look, I was on a show earlier today and someone typed in a question saying, well, the problem is fractional reserve banking. No. I'll ask people, name a country you would live in, right, that has a bad or non-functioning fractional reserve banking system. I'll wait, right? You won't, right? Because that's what makes habitable versus inhabitable, right? Fractional reserve banking is a really good thing because it says we can collectively pool our assets and lend them to one another and grow.
Right.
That's a good thing. Where it goes wrong is when the people at the top obfuscate and over-lever, right? You can rehypothecate maybe 10, 11 times and be safe. If you get to 20 or 30 or 40, like Lehman Brothers or Deutsche Bank, that's bad. And if you're stealing, right? If somebody at the top is stealing from the depositors and, not keeping the gold in the vault like it's supposed to be, then bad things happen. But those are human problems. That's not a system problem. The fractional reserve system is actually pretty good because without it, I don't think you get enough growth for what humans want, right? Humans, we're positive, we're creative, we're energetic, and we want to build, we want to grow, we want to take risks. I mean, not all of us, but the good ones want to take risk and build new things.
Yeah. It's a fascinating way that you kind of break all that down and the history of it's incredible. You always said to me, Mark, and you said in the last episode that we want to replace trust with truth. And I think that's what you were alluding to. We pay 6 to 8% of global GDP, 7 trillion a year for that trust. And again, we all need it. We all use it. There's great examples where it saves our bacon, but is it worth that much? Probably not. And when you
Probably not. And look, here's the thing. We didn't have an alternative before.
Right.
Right. Yeah. I put my money in the bank and I trust that they will take care of it because now it's their money. This is the weird part, right? When you put your money in a bank, you put your money in a brokerage account, it's now theirs, right? If I look at my ownership of, I have on my wall a certificate of 1 share of Cisco, because back in 2000, I said when it was going crazy, I said, this thing's going to $5. And it almost got there. And so they bought me 1 share. Well, if you look at the DTCC, Depository Trust Company, it doesn't say Mark Yusco, right? It says UBS. UBS owns that share. And I have an IOU from UBS that I could get to that share or I could get to the value of that share, but I don't own the share. Same thing with my money at Bank of America. Well, not Bank of America anymore because I fired them, but Truist Bank. So I put my money in Truist Bank. It's their money. And I have an IOU that's good 99.99% of the time. The problem is if it's at 0.01, like Cyprus or La Jolla National Bank, it's bad. So here's what happens is I have a recurring nightmare, and it's not all the time, but maybe once a year. I go to the ATM, I punch in my code, and it says 0. How would I prove it's not 0? I'm trusting them that the money I put in, they didn't take. But if they said it was 0, I don't have a statement. I haven't had statements in years. It would be their word against mine. Now, I could probably, sue them and get the records and say at some point back in the computer files, it said you had money and then there was an entry. But who knows? But that trust is worth it because I don't want to keep the money at my house because look, I do not want to go back to the days of where you had to sit on your porch with a gun. And as long as your gun was bigger than the bad people's gun that showed up at your house to take your stuff, I don't want that. I like having a central repository for value, and then I can use that capital for other things. I don't want to keep it all. It is my one pet peeve about Bitcoin. As much as I love it, and as much as I love digital assets, bearer assets have a risk.
Yeah.
And that risk is that if I have to put it in cold storage and I lose my seed phrase or I forget my password, it's gone forever. It's like, I use the example of money the way you think about it now. How much money's been stolen from the Federal Reserve? $0. How much money's been stolen from Bank of America's main office in New York? $0. How about Bank of America, El Paso, Texas? Actually, more than $0. That bank has been robbed before. How about people's wall safe? More than $0. How about your purse or wallet? The further you are from the money, the more at risk it is, right? It's a bearer asset. You could lose money from your wallet and you never get it back, right? So, but for a small amount of money that you carry in your purse or wallet, that's no big deal. With all of your wealth, if you put all your wealth in Bitcoin and you forgot your seed phrase, that would be a bad outcome. So that's why these centralized, services. So we have TradFi and you have CeFi, like blockchain, or like Coinbase and others. Who say, "Oh, not your keys, not your coins." I'm like, yeah. And you have all the risk to the centralized organization. They can take your stuff. But is the risk of my dad at 86 forgetting his seed phrase or losing his seed phrase worth it versus him being very comfortable that he owns Bitcoin at Coinbase? I don't know. It's fine with me. And I don't want to hold his keys because if I mess him up, then I'm in trouble. So I do think ultimately we can get to a world where everything is fully decentralized, but we need some better UI UX. We need some better security measures. And look, it's a real operational security risk that if you have all of your wealth on this and someone comes into your home with a gun, and they don't point it at you, they point it at your family and say, give up the seed phrase. And I've heard people, I'll go to my grave. I'm like, okay, great. That helps nobody. So I don't want to get back to a world where it's hard to rob a bank, right? It's easier to rob an individual. And I'm not saying you should go out and rob people, but sadly, there have been attacks on, wealthy Bitcoiners and others. And so one of the things I don't really understand is when people flex exactly how much money they have. And are you just inviting trouble? It just seems like a bad idea, generally.
Yeah, we definitely need some innovations in security. I teach in my Crypto and DeFi Academy. I graduated over 1,000 students, and I get them to go through this process. And when they're setting up their MetaMask wallets and their Nano Ledger X's, I tell them, don't hide your treasure from yourself in the classic, Pirates of the Caribbean style. You got your treasure map, you bury it on the island, you go back and the island isn't there, your map is wrong, and now you're your worst enemy when it comes to that. And so
I love that analogy. That's so good. It's so good. Yep.
Yeah, well, because
exactly right.
I have 2 little boys, they're 6 and 7 years old, and they love pirate stories. And one night, my son Caden said, Papa, how come pirates have treasure maps? And I paused and I said to him, because they didn't have Bitcoin. And my thought was they couldn't go to banks, and so they couldn't hold their value anywhere. So they had to have these maps that would show them where their treasure was. And it was immediately, that's what I told him. And he was like, what's that, Papa? And so I started coming up with these analogies. And so now I have this kind of pirate Bitcoin analogy. And one of those is, first of all, we have Bitcoin now to hold your assets when you can't trust a central bank because a pirate maybe couldn't do that. But then also you have the same problem pirate had, which means you probably rarely found your treasure when you walked 60 paces from the coconut tree and realized it's not there for whatever reason. So
look, I mean, 60 paces could be different for different people. And the tide could have come in and moved your stuff. So there's all kinds of problems with that. In fact, I love the analogy because I've talked about one of the challenges I have of hardcore Bitcoin maxis. And I don't mean that in a disparaging way, but there are people who are self-proclaimed, anything other than putting your Bitcoin in cold storage and holding it forever is not a good use. I'm like, well, but here's the problem with that. If the only use of Bitcoin is to put it on a nano and bury it in the backyard, we have that. We can all go home and get go back to work, get our old jobs, because that's called gold. And gold has been doing that for 5,000 years. And if you bury it in the backyard, it doesn't degrade, whereas we don't know what happens to a nano if you bury it in the backyard. And the reality is, I think what you need is Bitcoin to become the base layer of money the same way gold is. Gold owned by the central banks, okay? And then all the countries issue their own currency, not money, it's currency, on top of the money. And then we deposit it in the institutions and it gets lent, and that fractional reserve process creates prosperity. So the same thing has to be true of Bitcoin. It needs to be deposited, lent, invested, borrowed, utilized, and it needs to become that base layer the same way gold has. And does that mean gold goes away? Well, not tomorrow, but it certainly could. And it could be replaced for everything other than Mad Max, right? The Mad Max scenario where the power grid's down and you need the gold bar to get out of the place to cross the border. We all heard stories of Germany and et cetera. But that's a pretty small, likelihood. But what's more likely is we're going to continue to evolve and innovate, and we're going to get to a point where everything is going to be digital. So you've got young kids. I have older kids, and I always use this prop for my granddaughter. I have a 1-year-old granddaughter, and she will never have one of these. She'll never have a leather wallet, right? She'll never use paper money. She won't know what any of those things are. It will be totally commonplace to have a digital wallet, to use digital assets. And that world is coming. And it's the same as, the world in which you're in the back of your car, right? No one will drive anymore. You'll be driven, and you're in the back of your car, and it'll pull into the charging station, and you won't get out of the car and put your plastic card in a slot. I mean, just no. The car will make a micropayment to the machine, right? Using some cryptocurrency, maybe Bitcoin, maybe something else. And then it will pull away and you'll get into traffic. You say, I don't want to sit in traffic. I want to go in the fast lane. You pull in the fast lane. You won't have a picture of your license plate and get in the mail a bill for $4.70. You'll have a microtransaction from the car to the lane. And so all of this digitization is going to happen, and it will take the friction out. And yes, it will harm the industry that relies on that as revenue. The trust industry revenue will fall. Okay, but that's okay, because every industry gets disrupted at some point by innovation, right? You go back thousands of years, the church had the monopoly on information. People didn't read, they didn't write. They went to church every week and they were told, here's the news, here's what to think, here's what to do, here's where to pay your taxes, we'll protect you, all good, community. No one traveled, that's what you did. Then the printing press comes along, bust the monopoly. Now suddenly you could teach people to read, you could teach people to write, you could transfer information across long distances. Took a while, but you could take a book from one place to another. And so the church monopoly was broken and the governments took over. And governments, either through owned media or state-sponsored media, like in America, where you had 3 television channels, but they all said the same thing, what the government told them to say. And that monopoly got busted open by the internet. Because now we can have information ubiquitously everywhere. And I use a simple example of politics, right? In the old days, if I want to know about the Argentinian election, I would have to wait for the editor in New York to send someone to BA, have them write a story, have it go back and forth, and then 3 days later, I'd read about it in the New York Times if I opened to page 17, right? Today, I go on Twitter and watch a periscope of someone standing in line for 2 hours chanting Milei's name. Like, yep, that's who's going to win. That's far superior in terms of information transfer than the old system. And so we busted the monopoly, and those state-owned media assets became less valuable, and the big state-owned monopolies of distribution became less valuable, and Amazon and Netflix became very valuable. Now we have blockchains which disrupt financial services because trust gets replaced with truth, and truth having a third entry in the accounting, right? I have a ledger, you have a ledger, and now we don't need the Medicis. We have a third ledger validated by thousands of people around the world that gives us truth. I can't change it. You can't change it. It is immutable, permanent. And that truth does 2 things. One, it reduces the frictional cost of finance. So now I can exchange value with you for free, which is probably not the right number. There should be some frictional cost. But the thing it also does is it unleashes, I think, the most powerful force in the world, which is human creativity. Because if I no longer, and that's a highly politically charged word, but if I'm no longer a slave to fiat, meaning I'm no longer paid in an asset that can be taken back from me through inflation, the insidious little, stealth wealth tax. So basically, you're paid your salary in a money that the government can make less valuable by fiat, by decree. And therefore, if you don't spend it, it gets less valuable. Okay, but what if I don't want to spend it? What if I want to save it? What if I want to invest it? Why should it get less valuable? Well, the rich have the luxury of investing that fiat in stuff, and that stuff isn't priced in stuff, right? We don't price houses in houses. We don't price, businesses in businesses. We price those things in dollars. So as the value of the currency gets lowered, by printing more of them, the value of the assets goes up. But the people...
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.
So Jim Rickards has just recorded a video that's not available to anyone in the public, and he's going to be talking about how this upcoming recession is going to be fast, it's going to be bloody, it's going to be nasty. But at the same time, he's going to show you how you can position yourself to profit from all of this chaos. Now, we've made this video only available to our viewers. Go to londonreal.tv/Jim, watch that immediately. I can't say enough good things about Jim Rickards. He understands the global economic system better than any guest I've ever had on London Real. His predictions are almost uncannily true, and you can learn how to profit from his vision, from his expertise, and his understanding of economics. So go to londonreal.tv/Jim or click the link below. It's an excellent, excellent look on what's going to happen in the future and how you can position yourself to profit from that. Jim is one of the best in the business, one of my favorite guests on London Real. And he's very, very good at predicting the future and showing us all to profit from it. So click the link, and I hope you enjoy. Hey, it's Brian Rose, founder of the DeFi Academy. I've told you my 4-week crypto bootcamp is amazing, but don't take my word for it. This is what my students are saying.
The DeFi Academy was an amazing experience for me. It took me totally out of my comfort zone.
In this course, I was challenged, I was held accountable, and pushed to do things that honestly weren't always easy.
It's been phenomenal, and I can't believe we're already up on our 4 weeks. It has flown by.
Going through this DeFi accelerator by far was one of the best courses I've taken.
You do this course, you really get into the nitty-gritty of the activities that will make you comfortable with decentralized finance.
Thank you so much to Brian and everyone at London Real and the DeFi Academy for even putting together an amazing course like this.
Anybody else that wants to do it, please sign up. It is well worth the money.